Good day everyone. Welcome to Behind Candles Core FX series, where we will go through the most essential things regarding Forex trading. In order to fully understand concept of Forex market, you need to understand what it's contained of. The vast majority of Forex traders use candlestick charts, and they are considered to be the most complete on the market. That is why we need to understand their background and what drives them to develop a perception of market movements. There are three key topics we will cover in this series to recognize what is behind candles. In this video, I will explain volatility and how volatility defines candlesticks and market. First of all, you have to understand the concept of the market. The way volatility moves the market and how it's bonded with will help you with market analysis and trading decisions. The second thing that is crucial is the way you are going to implement your knowledge about volatility into your trading. Complexity of the market can give you a hard time regarding decision making, but simple and correct approach will help you through the process. The last thing, but probably the most important one for beginners, is managing the risk. This is where volatility knowledge gets very important, and will help you to minimize your losses and keep trading profitability high. These three things have to be applied in all three concepts of this Forex Trading FX core series. Following all steps correctly will properly shape you as a successful trader. In the drawing below, you can see candlestick and its variables. Each candlestick has an open price, close price, and of course, high and low price, or with other words, the points where market made extremes during given period of time. So, the space between highs and lows of the candle is called candle spread, or the range, and it is defined with volatility. When we have high volatility on the market, price will move faster than usual and candles will have wider range, and vice versa. So those moves that define the ranges can be overextended and underextended from the average. On the right side of the screen you can see how you can calculate those averages and get better understanding when market is behaving different than usual. As we concluded previously, volatility defines the range of price movement, and generally it can be very useful to understand volatility. There are various things that can affect volatility, and those are volume, market expectations, fundamentals, and order flow. On the left side of the screen you can see example how wide and narrow range candles look like in comparison with each other. But switch to the right side of the screen and take a look how sometimes our eyes can play a trick on us if we don't pay close attention and look things in the concept of the market. You can now see that our wide and narrow range candles from the left side don't seem the same in the right side picture. Our wide range candle now seems much more exaggerated, and narrow range candle looks completely different. Now it looks more like a widespread candle with increased volatility. In this picture you can see two types of market conditions: market consolidating and market trending. First, market is consolidating in average range movement, which means volatility is quite average comparing to overall market conditions. After consolidation part is done, market makes a move, and move is based on increased volatility. Now candles make more of a range and market starts to trend. As higher volatility is still present on the market, price retraces aggressively, just the way it went trending before. Effect remains the same like the first time, and price gets back quickly. After retracement is complete, market conditions are back to its pre-trending state. Volatility decreases and market consolidates once again. Now, when we know basic principles of volatility and the ways how it directly affects market conditions, we can dig into more details. There are certain times during the day when market tends to move more, followed by increased volatility. It usually happens during European and North American sessions, especially at the time when they overlap. In the picture below, you can see how candles usually move during specific times on the day. This happens because majority of traders are active during European and North American sessions, therefore most of liquidity is generated at those times of the day. What you can also see is that you can calculate average movement by each session to help you understand market conditions and to differentiate average and non-average movement. This Euro-JPY chart shows average movement during Asian, European and North American sessions. Finally, we have example on how to use volatility in your trading and how to improve your risk management. This is Euro JPY 1-hour chart. On the left side of the screen you can see volatility calculations. Here, we calculated daily in-session average candle movement. This is type of information that you can use to comply your technical setup and risk management. First, we have to identify key zones on the chart, and create some sort of market movement expectation. On the chart you can see how we identified crucial zone and waited for next market move. Secondly, after session resistance got broken by a candle, price moved along with trend, so bullish in this case. Thirdly, in case you missed to enter the breakout, knowing average 1-hour candle movement, you could have avoided entering market at the peak and risking potential drawdown situation. And finally, better opportunities could be found after we got confirmation that market will remain going with the trend, in our case, bullish. Check how volatility remained the same, and new opportunities could be found right on new formed support, or at new breakout. So now, if you entered a bit lower, you can have better risk to reward and no drawdown situation, knowing there is more of a potential for price to go up, based on average daily movement. Thank you for watching this video and see you in next episode.